I told you the next big economic crisis in Detroit might not be caused by a recession, but by a trade war with our closest neighbor? Imagine this: Ford and GM, the titans of American roads, watching their stock prices nosedive, not because they can't sell cars, but because the U.S. government decided to slap heavy auto tariffs on Canada. Sounds dramatic? It should. Canada isn't just America's friendly neighbor with maple syrup and hockey. It's also the second largest exporter of auto parts to the U.S., a crucial cog in the supply chain that keeps our factories running and our dealerships stocked. Push too hard, and that cog could snap. In the short term, prices could spike, jobs could be lost, and assembly lines could grind to a halt. In the long term, America risks losing its grip on the global auto stage, handing the steering wheel to rivals in Europe and Asia. And here's the kicker. History tells us that when you weaponize tariffs against your biggest partners, you often end up shooting yourself in the foot, or in this case, slashing your own tires. Stay with me until the end, because we're going to uncover how a single trade policy decision could ripple from Washington to Wall Street, from the showroom floor to your own driveway, and why Ford and GM might be in for the ride of their lives. Context. To understand the stakes, we first need to zoom out and see the full picture of America's auto industry and its relationship with Canada. The United States is not just a car market, it's one of the largest automotive production hubs in the world, churning out more than 10 million vehicles annually. Detroit, Michigan may be the spiritual home of the American car, but the reality is far more interconnected. Canada, just across the border, isn't a casual trade partner, it's a deeply integrated part of the U.S. auto supply chain. According to the U.S. Department of Commerce, over $25 billion in auto parts and vehicles cross the U.S. Canada border each year. We're not talking about finished cars simply being imported. We're talking about a shared production ecosystem where parts cross the border multiple times before a car is even complete. A brake assembly might be manufactured in Ontario, shipped to Michigan for installation, sent back to Canada for further work, and then returned to the U.S. for final assembly. It's a cross-border dance choreographed over decades, with NAFTA and later USMCA acting as the rulebook. That's why any disruption doesn't just hurt Canada, it ricochets straight back into American factories, dealers, and consumers. Right now, the U.S. government is flirting with the idea of imposing steep tariffs, potentially up to 25%, on Canadian autos and auto parts. Officially, the justification is to protect American jobs and encourage domestic manufacturing. In political speeches, it sounds like a rallying cry for patriotism. But in boardrooms and factory floors, it sounds like a disaster in the making. Why? Because the U.S. auto industry isn't set up to replace Canadian supply overnight. Retooling factories, finding alternative suppliers, and absorbing the cost of higher-priced domestic parts takes years, not weeks. In the meantime, automakers like Ford and GM would either have to eat the costs, slashing their profit margins, or pass them on to consumers, slowing sales. Neither option is good for shareholders. Let's put numbers on it. Analysts estimate that a 25% tariff could raise the cost of an average car by $1,000 to $3,000. Multiply that by millions of vehicles sold each year, and you're looking at billions in extra costs hitting consumers' wallets. For automakers already juggling EV investments, union wage negotiations, and global competition, this is the equivalent of pouring sugar into a gas tank. It might run for a while, but it's going to break down. And here's where the market comes in. Ford and GM stocks are hypersensitive to cost shocks and trade disputes. A single tariff announcement can send shares sliding in hours. With U.S. Canada trade so tightly bound, investors know that escalating tariffs could mean production delays, slimmer margins, and ultimately, weaker earnings reports. In short, the U.S. Canada auto relationship isn't a casual handshake, it's a welded joint. And right now, Washington is reaching for a hacksaw. The misstep. On paper, the idea sounds simple. Slap tariffs on Canadian autos and parts, and suddenly, American factories will roar back to life, creating jobs and boosting domestic output. In reality, it's the economic equivalent of trying to fix a sophisticated engine with a sledgehammer. The misstep here isn't just the tariff itself. It's the fundamental misunderstanding of how the modern auto industry works. Politicians pitching this policy seem to imagine a 1950s America, where every part of a Ford or GM vehicle was made in Dearborn or Detroit. But today's auto production is a finely tuned, internationally integrated supply chain. Break one link, especially one as critical as Canada, and the whole chain seizes up. The proposed tariff, rumored to be as high as 25%, would instantly jack up costs for automakers. Ford, for instance, sources everything from engines to transmissions from Canadian plants. GM relies on Canadian-made components for popular models like the Chevy Silverado. These aren't luxury extras. They're mission-critical parts without which production lines grind to a halt. Industry analysts warn that such tariffs would trigger price shockwaves across the market. If automakers pass the extra costs on to consumers, average vehicle prices could rise by thousands of dollars. If they absorb the costs instead, profit margins would shrink, sending a chill through Wall Street and eroding investor confidence. Either way, Ford and GM shareholders lose. From a trade relations standpoint, it's an even riskier gamble. Canada is not China. It's America's closest ally, bound by USMCA trade agreements that were supposed to stabilize cross-border commerce. Imposing steep tariffs on such a partner risks retaliatory measures. Ottawa has already hinted that if Washington pulls the trigger, Canada will respond in kind, potentially targeting U.S. agricultural exports, steel, and even U.S.-made vehicles sold in Canada. And let's not forget the political optics north of the border. Tariffs would be seen not as tough bargaining, but as betrayal. Canadian politicians, regardless of party, would have no choice but to push back hard to save face domestically. That's not a trade war you win by default. It's one you escalate until both sides are bleeding. Financial markets have seen this movie before. In the 2018-2019 U.S. China trade war, mere tariff threats triggered billions in stock market value to evaporate in days. Automaker shares swung wildly as investors tried to calculate the fallout. Ford and GM, already battling high labor costs and expensive EV transitions, can't afford another external shock of that scale. And here's the bitter irony. Instead of protecting American jobs, such tariffs could destroy them. If production slows due to higher costs or supply shortages, the first casualties will be American assembly workers facing reduced shifts or temporary layoffs. Protecting the industry by hurting its own workforce? That's a political ad waiting to happen. In short, the tariff plan is less a strategic maneuver and more a self-inflicted wound. The White House might frame it as defending Main Street, but the fallout will land just as hard, if not harder, on America's own factory floors and trading floors. Lessons from history. This isn't the first time America has used tariffs as a blunt instrument, and history has a nasty habit of reminding us that such moves rarely end the way policymakers hope. Two examples stand out like flashing warning lights on a dashboard: the Smoot-Hawley Tariff Act of 1930 and the U.S. China trade war of 2018 to 2019. Let's start with the 1930s. Facing an economic downturn, Congress passed the Smoot-Hawley Tariff Act, slapping steep duties on thousands of imported goods to protect American farmers and manufacturers. The result? Other countries retaliated. U.S. exports collapsed, global trade shrank by nearly 2/3, and the Great Depression deepened. Instead of safeguarding jobs, the policy helped wipe them out. Economists still cite Smoot-Hawley as a textbook case of how protectionism can backfire catastrophically. Fast forward to 2018. President Trump's administration hit China with tariffs on hundreds of billions of dollars worth of goods, aiming to fix trade imbalances and push Beijing on intellectual property issues. China responded in kind, targeting U.S. exports like soybeans, pork, and automobiles. Markets hated it. Stocks swung wildly, supply chains were disrupted, and U.S. manufacturers, especially automakers, faced higher input costs. A study by the Federal Reserve estimated the tariffs actually reduced U.S. manufacturing employment rather than increasing it. There's a clear pattern here. When the U.S. imposes broad, aggressive tariffs, the targeted country almost always retaliates. And when that country is a major trade partner, whether it's China in 2018 or Canada today, the blowback is swift and painful. The protection often ends up looking more like economic self-sabotage. For the auto sector, the parallels are even sharper. During the U.S. China tariff fight, American automakers saw costs jump and sales in China slump. GM's China sales, for example, fell sharply in 2019, dragging down its overall revenue. Meanwhile, input costs for steel and aluminum, both tariffed products, spiked, squeezing margins further. Investors punished the stocks accordingly. Ford and GM shares dropped double digits during the height of the dispute. Now swap China for Canada. The geography changes, but the dynamics are eerily similar. Canada is a top-tier export market for U.S.-made vehicles and a critical supplier of parts. Retaliation from Ottawa could hammer U.S. agricultural exports and even restrict U.S.-built vehicles entering Canada, a market worth billions annually. Just like in 2018, costs would rise, sales would fall, and the very companies the tariffs were supposed to help would be left scrambling. And here's the kicker. In both historical cases, the damage wasn't limited to the targeted industries. Tariffs acted like a tax hike on the entire economy, raising prices for consumers and businesses alike. The pain rippled outward, hurting small businesses, farmers, retailers, and workers far beyond the original policy scope. History's verdict is clear. Tariffs on key trading partners rarely deliver the promised benefits, and they often trigger a chain reaction that leaves everyone worse off. Ignoring that lesson now would be like ignoring your check engine light while flooring it down the highway. You might keep going for a while, but you're courting a breakdown that could have been avoided. If the U.S. moves forward with steep auto tariffs on Canada, the short-term and long-term consequences will be more than just economic numbers on a spreadsheet. They'll be felt in assembly plants, on dealership lots, and in stock portfolios across the country. Short-term, 6 to 12 months. The first shock would hit production lines. With Canadian-made parts facing a 25% price hike overnight, automakers like Ford and GM would be forced to make quick, painful decisions. Either they absorb the costs, slashing their margins, or pass them to consumers, risking a slowdown in sales. Some models could see price tags jump by $1,000 to $3,000, according to industry estimates. Production delays would likely follow. Many U.S. plants rely on just-in-time delivery from Canadian suppliers. Tariffs would disrupt that flow, leading to bottlenecks. Even a few days of halted assembly can cost automakers millions. Workers, especially in border state plants, could face reduced shifts or temporary layoffs. On Wall Street, analysts wouldn't wait for quarterly earnings to act. Ford and GM stocks are notoriously sensitive to trade policy headlines. A credible tariff threat could shave billions off their market caps in days. For investors already wary about the company's expensive EV transitions and competitive pressures from Tesla, Toyota, and foreign automakers, this would be another reason to sell. Long-term, 3 to 5 years. If the tariffs remain, supply chains would be forced to reorganize, but that's easier said than done. Building new domestic parts manufacturing capacity takes years and billions in investment. In the meantime, automakers might shift more production offshore to sidestep tariffs entirely, ironically exporting jobs that the tariffs were meant to protect. Canada, meanwhile, would not sit idle. Ottawa could impose counter-tariffs on U.S. goods, especially agricultural exports and industrial equipment, hurting other sectors of the American economy. Trade tensions could sour the broader U.S. Canada relationship, making future cooperation on energy, defense, and climate initiatives more difficult. Global competitors would pounce. While U.S. and Canadian automakers fight a costly tariff war, European, Japanese, and Korean brands could capture market share in both countries. That could erode the North American auto industry's dominance for a generation. From an investor standpoint, prolonged tariffs could push Ford and GM into a cycle of weaker earnings, reduced dividends, and diminished R&D budgets. That, in turn, would slow their EV innovation at a time when the global market is racing ahead, risking a replay of the early 2000s, when foreign automakers surged while U.S. giants stumbled. The bigger picture. Beyond cars, this policy could send a chilling signal to global markets that even America's closest allies are fair game for trade aggression. That uncertainty raises the risk premium for doing business in the U.S., potentially dampening foreign investment and strengthening the case for diversifying supply chains away from America. The bottom line? The tariffs might start as a political talking point about protecting American jobs, but over time they could undermine the very foundations of the U.S. auto industry, its integrated supply chain, its export markets, and its investor confidence. It's the kind of protectionism that doesn't just guard the fort, it burns down parts of it in the process. The ripple effect. When Washington and Ottawa go head-to-head over autos, the tremors don't stop at the border. The U.S. Canada auto supply chain is so deeply woven into the broader economy that pulling on one thread can unravel far more than the fabric of car manufacturing. Regional impact. North America's economic heartbeat. The first ripples would hit border states like Michigan, Ohio, and New York, where factories, warehouses, and logistics hubs depend on a seamless flow of goods across the Great Lakes. Local economies could feel the pain quickly. Slower production means fewer shifts, which means less spending in local businesses, from diners serving plant workers to suppliers providing everything from seat foam to software. On the Canadian side, industrial hubs like Windsor and Oshawa would take their own hits, triggering layoffs that reduce cross-border consumer spending. Remember, millions of Canadians travel to the U.S. each year to shop, vacation, and attend events. If jobs dry up in Ontario's auto belt, that discretionary spending in American border towns vanishes too. Trade chain reaction. Canada wouldn't just retaliate with tariffs on cars, it would likely target politically sensitive U.S. exports like dairy, beef, whiskey, and agricultural machinery. That would draw farmers and ranchers into the fight, creating new pressure points on Washington from states far removed from the auto industry. This tit-for-tat could also drag Mexico into the crossfire. As the third partner in USMCA, Mexico's auto sector is intertwined with both the U.S. and Canada. Tariff disruptions could reroute parts flows through Mexican plants, straining their capacity and potentially prompting Mexico to adjust its own trade policies in response. Global financial markets. Investors worldwide watch U.S.-Canada relations as a proxy for the stability of North American trade. Tariffs between these two close allies would be a red flag that political risk in the region is rising. That could spook foreign investors, pushing them to diversify into Europe or Asia instead. Commodity markets would also feel the heat. Canada is a major exporter of metals like aluminum and nickel, both crucial to auto manufacturing and EV battery production. If Ottawa retaliated by tightening exports or imposing its own duties, the global prices of these materials could spike, raising costs for automakers far beyond North America. A warning shot to allies. Perhaps the most damaging ripple is diplomatic. If America is willing to impose steep tariffs on Canada, a NATO ally, USMCA partner, and historically one of the most reliable trade partners, it signals to the rest of the world that no one is safe from sudden, politically driven trade moves. Allies in Europe and Asia may begin hedging their bets, seeking alternative markets and suppliers to reduce dependence on the U.S. The unintended beneficiaries. While North America fights itself, rivals benefit. European and Asian automakers could gain market share in both the U.S. and Canadian markets, positioning themselves as safe suppliers, unaffected by cross-border disputes. Long-term, that could erode the competitive position of both American and Canadian auto industries. In short, the ripple effect of a U.S.-Canada auto tariff war would spread far beyond assembly lines, shaking local economies, agricultural markets, global trade relationships, and America's standing as a reliable economic partner. The waves may start in Detroit and Ottawa, but they would crash on shores worldwide. If Washington truly wants to protect American auto jobs without detonating a trade grenade in North America, there are smarter ways forward. The U.S. and Canada have navigated trade disputes before, sometimes with bruises, but often with a handshake in the end. The challenge now is choosing the path that avoids turning a political talking point into an economic own goal. Solution 1. Targeted negotiations, not blanket tariffs. Instead of imposing a sweeping 25% tariff, the U.S. could push for targeted agreements on specific supply chain concerns, such as rules of origin requirements under USMCA or commitments to maintain certain production levels in American plants. This narrows the focus to actual points of contention without torching the entire trade relationship. It also gives both sides room to claim political wins without mutual destruction. Solution 2. Incentivize domestic production. Don't punish imports. If the goal is to strengthen domestic manufacturing, carrots often work better than sticks. Tax incentives, R&D grants, or subsidies for U.S.-based auto parts production could encourage reshoring without sparking retaliation. This approach takes longer to show results, but avoids immediate supply chain chaos. Solution 3. Joint competitiveness initiatives. Both the U.S. and Canada are facing the same existential challenge in autos, the global EV transition. A cooperative North American EV supply chain strategy, covering batteries, raw materials, and assembly, could position the region as a united front against Asian and European competition. A tariff war would do the exact opposite. Now, let's map out 3 possible scenarios if Washington stays or strays from the edge of the cliff. Best case scenario. The tariff threat is used purely as leverage. Intense negotiations produce a compromise. Canada agrees to some U.S. demands on supply sourcing, and tariffs are shelved. Markets breathe a sigh of relief. Ford and GM stocks rebound. U.S.-Canada relations remain intact, and both countries focus on competing globally, not fighting locally. Middle ground scenario. Tariffs are imposed, but at a lower rate, say 5 to 10%, coupled with a clear timetable for review. This creates short-term disruption and market jitters, but the damage is contained. Supply chains adjust slowly, and retaliatory measures are limited. Still, investor confidence takes a hit, and the trust account in U.S.-Canada relations is partially depleted. Worst-case scenario. Washington goes all in with a 25% tariff. Ottawa retaliates with tariffs on U.S. autos, agriculture, and industrial goods. The dispute drags on for years. Production costs soar, car prices spike, and both Ford and GM see stock prices slump as profits erode. Layoffs hit American and Canadian auto workers alike. Meanwhile, Toyota, Hyundai, Volkswagen, and others scoop up market share. The political fallout? A souring of one of America's most important alliances. The reality check. The auto industry's cross-border integration means there's no win in an all-out tariff fight between the U.S. and Canada, only degrees of loss. The smartest move isn't to win the war, but to avoid starting it in the first place. Tariffs on Canadian autos might sound like a bold, decisive move to protect American jobs, but in reality, it's like playing chicken with a mirror. Whatever damage we inflict on Canada will ricochet straight back into our own factories, wallets, and investment portfolios. We've seen this story before. From Smoot-Hawley in the 1930s to the U.S. China trade war just a few years ago, aggressive tariffs on major trade partners almost always spark retaliation, disrupt supply chains, and leave both sides worse off. And this time, the stakes are even higher because the U.S. and Canada don't just trade, they build together. Every vehicle rolling off an assembly line in Detroit or Windsor is a testament to decades of shared production, shared jobs, and shared prosperity. Ford and GM are already balancing on a tightrope, investing billions in electric vehicles, navigating competitive pressures, and facing skeptical investors. A tariff war with Canada wouldn't be a helping hand, it would be a shove toward the edge. So the question isn't whether we can win a trade fight with Canada, it's whether we're willing to lose together. The smarter path is negotiation, cooperation, and investing in our own competitiveness, not taxing the lifeblood of our most important industries. If you've stuck with me this far, you know the real cost of this policy isn't measured just in dollars. It's measured in jobs, trust, and the strength of one of America's closest alliances. What do you think? Are these tariffs a necessary tough love move or a dangerous self-inflicted wound? Drop your thoughts in the comments. And if you found this breakdown eye-opening, hit that like button, share it with someone who needs to understand the stakes, and subscribe for more deep dives into the drama shaping our global economy. Because the road ahead is bumpy, and we're just getting started.